Hello, YouTube. Today we note that the stock market is crashing. So the question is, how low are we going to go? Are we going to hit that 50 DMA? Are we going to pause? Or are we going to go up? That's the big question for today. And the reason I say that is because the market is now ticking right back down to the lower bound of neutral. And it's pretty easy for us to fall back into fear. 2 more points, right back down into fear. And this could become a self-fulfilling prophecy where the bears start to flex. So in today's video, we want to talk about what is notably changing ever since we hit the high at about 430. So as we look here, we note that our low of the day is 412.4. We also note that we've now filled our daily gap. Our gap right here going back to August 9th is 412.75. That has now been filled. So we're closing here and we're about $1 higher in after hours. And the really important question is there something different that is happening on the daily chart? Answer is yes. And the answer is yes because with Jackson Hole coming up on Friday and post our $2 trillion options expiry on Friday, this looks like bearish continuation that really started on Monday, but is now starting to really accelerate. Volume is not super high, but for the summer, this is now elevated. So we're now higher than the 50 average, and we have increasing price as we have increasing volume with decreasing price, which is generally pretty bearish. I would also note that we're now coming back down to our pink box. And when we look here on the left-hand side, our pink box led to consolidation and then a massive shoot down. On the right-hand side, we have consolidation, then a shoot up. And what's different here, and what changes my thesis in terms of where we're going to go, at least for now, is that we did not look back. We shot all the way down. It was a straight line. Over here, we went up once, climbed the wall of worry, and now we're down by 4.5% off the highs. That's almost a dip. A dip is roughly 5%, and we're down by roughly 4.5 now. We are 90% of the way to a dip. What would a dip technically be? 5%? 410. Yep, if we get down to 410s or test that 410.64 low, that would be roughly 5% off the highs. And then if we keep going lower or we lose this, again, the relative low on our monthly chart, meaning we go down here, we're probably going down to that 50 daily moving average. So this 410 area is going to be particularly interesting for tomorrow. I would also note that there was a huge warning that we were going to be going down today. VIX was already up by 15% at the open. 2-year note is up. 10-year note is up. Inversion is up. Oil went from red to green, went up by 5%. DAX was already down 2% at the open. All we did was catch up to meet it there, closing out the day by 2% on SPY, closing down by 2.6% on QQQ. And if you look to the heat map, there was nowhere really to hide today. We got everything red, every sector, every asset class, every ETF other than FXI. And every $1 trillion company down, Bitcoin down, gold down, everything down. This is starting to really get nasty. So as you look forward here to, again, the reasons why this is happening, again, the market is going to choose the headline that it wants to fulfill its story. And right now, the market wants to go down. Is this going to be a two and done? I don't know. But it's really interesting that going into Friday is where we're setting the tone. So the tone into Friday will be really important. And post-expiry, again, meaning post-OPEX on Friday, what we would normally expect to see is a move like this. Closing at the low of the day and the low of the week on Friday leads to continuation to the downside today. Another thing I want to point out, now that we know that we filled our daily gap, we fell back inside our pink boxes, we also have one more thing which is characteristically different than anything since we formed our bottom in June here. So ever since we carved out our bottom in June, we note that we had, we have 3 red days here. Oh my goodness, 3 red days in a row with full candles, which means we closed lower than we opened. Then going to July, we have 2. Then since the expansion, we got 2 here in August 9 and 10. And now we got 2 over here as well. So if we get a third one, that'll be the first time going all the way back to late June, or basically when we formed our bottom. And the size of these candles is getting a lot larger, which means that there is a change, right? There's a change happening right now in the market. And again, if we look over here to our weekly chart, this is a really important area because it kind of signifies an inverse head and shoulders. If we lose that 410.64 low, what are we? Well, we're pointing down. All right, we're pointing down. We are losing our uptrend, and it's going to get increasingly more difficult for the bulls to take control of the chart. If we look back here to our SPY 1-month chart, we can also note that we've now lost our, we're almost back to flat in the month. Going back to last month, our high is 413.03. So we bounced off that 0.75 daily gap, and now we're right back to where we were at the high of last month. If we keep shooting down, this is going to turn into an inverted hammer, and that is generally going to be a reversal pattern. So if we note that if we keep going lower, meaning if we go below 412, and we lose our low of the month, it's pretty certain we're going to go down to 395 here, which is my dominant uptrend. Why does that also matter? Our 50 DMA is 395. You got it. Another thing I want to look at just to try to paint the story is what is happening here with the options, because the bears really got paid today. So they got paid on Friday, and they also got paid today. And if we look here to what actually happened, we note that we got, we closed at 413.35, which means that all of the partial payout on the 414s, all these got minted. That's a lot, right? 300,000, 300,000, 130,000. All the calls got smoked, basically, and that's okay, but lots of volume over here too, which means the bulls tried, but the bears had more in the tank. There was a lot of money paid out to the bears today. If we look forward to the Wednesday chain to see whether or not there is continuation, what do we have? Oh man, we got a lot of continuation here. We got 415 to 410 for volume. I want to see if it converts to open interest. I'm watching that closely here. On the call side, we got 420 and roughly 415. So 415 still looks like it's max pain. If the market's option sellers are in control, we should start to go sideways. If the bears are in control, we're probably looking for about 410. And what does that do? It breaks that 410.64 low. They need $1 back in premium to get anything. So if we don't go down to 409, they don't get their money back. They want their money back and they want more. So now we're going to close this out. We're going to look to Friday, which is going to be the day when we got Jackson Hole. So let's close that out. So as a reminder here, Jackson Hole happens on Friday. So if people are already positioned for Friday, it means they kind of think this is it. We're going to leave that daily gap on the chart, and we're just going to fade. So what do we got here? Oh boy, right, 420, 415, 410 with what? Open interest, open interest, open interest of 20K. Looks like a strategy. On the call side, we got 415 volume to 420 volume. So 415 still appears like max pain. I would note that the only calls which have open interest over here is going to be 415. And this looks like a straddle because we got volume on the 415 call and 415 put. And it looks like we have a 420, 410 put spread, which for me means that the bears want us down to below 410 by Friday. And because these options are priced at 250, it would imply a break even of 4075. Why is 4075 important? Oh boy, let's go back here to our monthly chart, and we note that, oh man, the low of the month is 406.82. Crap. So we're going to be pretty much where? Right back to the low of the month. Oh no. Yep. Oh no. And if you note here, I have some new psychology charts which I've shared on Twitter. So what I want to do is actually look over here. Here is a post I put out 2 days ago. You can go to our community tab on YouTube. You can click on the history does not repeat itself, but it rhymes. It'll bring you to some charts here on Twitter. I would encourage you to read them. I don't want to go through on this one here. I'll do these maybe tomorrow, maybe on Friday. Drop me a comment if you want me to review them. Otherwise, if you want to have your comment pulled up, reply. I will bring up the relevant comments on our Friday stream. The other reason why I want to look here is because everyone's looking at one side. Retail is usually not correct. Sometimes they are, but as a rule of thumb, they're usually wrong. And right now, 65% of people expect a down week. And with early price action lower, they're probably feeling a little bit cocky. Are they correct? I don't know, but everyone's kind of looking one way. So when everyone's looking one way, it means team risk reward is what? Looking the other way. Team probability is going to be continuation lower. So is team probability or team risk reward going to win today? I don't know, but it's an important data point. And thank you to everyone who always comes back and votes on these. I really appreciate it. Next thing I want to look at here is going to be, again, we understand Friday is going to be really important. But now as we look forward here to our why bull or bear, I'll give a very brief update because I went at this at length in the weekend video. Highly encourage you to watch that if you want to know more. So 50 weekly moving average rejection. So we're going to go through the bear scenario here just because it's a red day. What do we got? Oh boy, we got a massive stomp at the 50 weekly. We got a gap on the chart, just like where? Oh no, that was the last time it happened. It was over here. A weekly gap, not a daily gap, a weekly gap. This is unusual. We don't have a daily gap, a weekly gap on ES or the futures, but we do have one on SPY. So, right, check. DXY and TNX breakouts, absolutely. When we look here to DXY, it's up by, it's up a lot. It's almost at 109. And this is not a level we have seen in 20 plus years. So in more than 20 years, we have not been here to above 106.50. We're rocking, we're rocking, we're rocking. This is bad for stocks. When we look at TNX as well, or the 10-year Treasury note, what is happening? Oh, it's got a pretty big month. It's up 14% on the month. On the week, it is up by 1.6. But what's important is we have a golden cross. And just like on the dollar, how we formed a cup and handle, same thing's happening here. We got a cup and handle getting back above the crucial 323 or our 2018-2019 tops here. And then also looking at a head and shoulders. If we also get back above 3.23 on the 10-year note, I think there's going to be more pain ahead. Final things to look at here are just going to be 454 unpenetrable fortress. Yep, if we can't crack 430s and hold it, we're not going to get the 450. Deep recession risk. This might not be a US story, but the deep recession risk story is really catching steam when we look at what's happening in Europe with energy, natural gas up 5% today, oil reversing a 5% loss, and then China actually cutting its interest rate. And Jackson Hole, which is going to be the key date on Friday. So in about 10 minutes, that is really what I am paying attention to this week. If you want to know more, I would really encourage you to watch the weekend deep dive, which is going to queue up here in a moment, because the stage is set. We're getting early evidence the Bears are in control, but it'd be really important to be mindful of everything that really matters this week. So thank you for watching, and I really look forward to seeing you tomorrow. Thank you.